Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks moving higher here today ahead of inflation data, and investors, of course, still keeping a close eye on any signals coming from the Federal Reserve. We're digging into those headlines and more. And right now, there's just an hour to go until that closing bell. I'm taking a look at the major averages. The Dow up about 65 points. The S&P 500, your broad gauge, is up about 0.2%. The tech-heavy NASDAQ is up about 0.5%. Let's welcome in now our Fed correspondent, Jennifer Schonberger, and our data and markets editor, Jared Blickery, joining us to break down all the headlines. Jared, my friend, I'm going to start with you on the trading action so far.
Yes, we got the morning started with a record high in the NASDAQ composite. You can see it's up about 0.5% today, and let's just check out the intraday price action. A little bit off the highs, but still holding on to some decent gains there of about 106 points. And here's the Dow, just barely up. It's been down, it's been up, and just kind of trading sideways for most of the day. And the S&P 500, very similar story, although it has been green the entire day. You can see it's up a whopping 15 basis points. And then let's take a look at the small caps. S&P 600, one of the small cap indices that we track, down to 0.25%. Meanwhile, the Russell 2000 has more components, some of which are unprofitable. That's just slightly in the green there. And let's check out what's going on in the bond market, because the trend over the last few weeks has been down in long-term rates and short-term rates. That is continuing today. The 10-year down 4 basis points to 4.05%, and a little bit longer out on the curve, you got the 30-year that is down 9 basis points. That is a big drop, down to 4.69%. And only at the beginning of last week, it was about 30 basis points or so higher, almost 5% there. So that's a pretty big swing in just the span of 1 week. U.S. dollar index also down just a little bit. And before I hit some of the heat maps here, I just want to show you one ticker in particular that's capturing the attention of a lot of traders. This is 8Co Holdings. It is up 2,826% today. There is a tie-in from Dan Ives, which is now going to head this treasury company. It's a crypto treasury company. They are going to be housing a WorldCoin, which is a Sam Altman-backed venture, and they're going to also be buying Ethereum and Bitcoin. And then there's a Tom Lee tie-in. Has all the components you're looking for, perhaps, in a big story. But here's the max chart. This is a company, well, that's not working right now, but this is a company that's been around for a few years and has done a number of reverse splits. And so $65 per share is actually, I'm not able to advance here. So you know what, guys, I'm probably going to pass it back to you here. And I will check back on the interactive in a little bit here.
All right, thank you, Jared. And over to Washington, Treasury Secretary Scott Bessent turning up the heat on the Federal Reserve as President Trump reveals his top 3 picks to replace Powell. Jen, what is the latest there?
Hey there, Josh. That's right. Treasury Secretary Scott Bessent said over the weekend that the Federal Reserve is behind the curve and criticized the central bank for what he called mission creep. Speaking about that weaker than expected August jobs report released by the government on Friday, Bessent told Meet the Press that, quote, it shows President Trump was right about the Federal Reserve. He said they are too late, and because of the bad numbers, they likely would have been cutting in June. Now, Bessent's comments come as President Trump revealed late Friday that he has narrowed down the search for his top 3 candidates to replace Fed Chair Jay Powell next May to Fed Governor Chris Waller, former Fed Governor Kevin Warsh, and current director of the National Economic Council of Advisors, Kevin Hassett. Now, Bessent, who is leading the search for the next Fed chair and who has said himself that he does not want the position, said in an op-ed in the Wall Street Journal that the central bank needs to reestablish its credibility as an independent institution, and he called for an open, honest, independent, nonpartisan review. Bessent said the Fed has devolved into a monetary policy experiment, writing in that op-ed, quote, that overuse of non-standard policies, mission creep, and institutional bloat threaten the central bank's independence. The Fed must change course. He said its standard toolkit has become too complex to manage with uncertain theoretical underpinnings. Simple and measurable tools aimed at a narrow mandate are the clearest way to deliver better outcomes and safeguard central bank independence over time. Now, the secretary also pointed to the Fed's use of its balance sheet and purchase of treasuries and bonds as a way that has been steering capital throughout the economy. He maintains that that needs to be done by the markets and elected officials. Josh?
All right. Thank you, Jen. Thank you, Jared. Jen, while we have you, actually, during his confirmation hearing Thursday, Stephen Myron testified that he did not intend to resign from his position as chair of the Council of Economic Advisors, Jen. If confirmed to the Fed, Senate Banking Committee Democrats demanding that Stephen Myron resign from his White House job if he gets confirmed to the Fed?
Exactly. Senate Democrats on that Senate Banking Committee sent a letter to Myron demanding that he commit to resigning from his current position as head of Council of Economic Advisors for the president by today, September 8th, if he is confirmed by the full Senate to the Fed. The Democrats writing in that letter to Myron, quote, that this arrangement would not serve the best interests of the American people. It is ludicrous to contend that you could exercise independent judgment regarding monetary policy and financial regulation. And we do expect a vote by the Senate Banking Committee on Wednesday morning. I would expect that nomination to pass out of committee along party lines, setting up a full vote in the full Senate perhaps later this week. Would expect Myron to be in place for the FOMC meeting next week on the 16th and 17th.
All right. Thank you, Jen. Well, markets are indeed keeping a close eye on the Fed as investors await key inflation data that could provide a clearer picture on interest rates. Treasury yields retreating amid high expectations that the Federal Reserve will resume rate cuts. This comes after the U.S. 30-year yield climbed toward 5% earlier this month amid tariff uncertainty and threats to the central bank's independence. For more color on how to play the fixed income market, let's get to Jeff Given, Manulife Investment Management, Head of Developed Market Fixed Income. Jeff, it is great to see you, especially on set. Actually, I want to start, Jeff, with what my colleague Jen was just talking about there. This question about Fed independence. Are you getting questions about that, Jeff, from your clients? Is that a conversation? And what do you make of it? Is it real? Do you think it's a political talking point? Walk me through it.
We definitely get a lot of questions on that. I do think there is some truth to it, but at some point in time, the Fed has always in the past been a little bit of a political animal anyways. I think it makes really good headlines right now, so it's in front and center, especially with us a little bit of a turning point potentially for the economy at some point in time here.
Let me ask you, that weak jobs report we got, I'm curious what you made of it, what you think the Fed made of it. Did you think of it, Jeff, as okay, that rate cut's a lock?
I do think it's a lock at this point in time. I think it was very disappointing to see that number. I think it has transitioned from the Fed from worrying about inflation, which is part of their mandate, and they've been focused on for the last 2 years, to now after 2 really weak prints and downward revisions for a number of months, now they're going to be focusing solely on the employment aspect. So I don't think the CPI number in September means anything at all. I think they go 25, and then if we get another weak print in October for the September payrolls, that will spur another 25 basis points in October.
I had an economist on the show, Jeff. He didn't think 50 was off the table. What do you make of that?
You know, a lot of times that's a bad signal to the marketplace if they do 50.
In other words, if they did it, it would freak people out?
It would freak people out. You look at all the other times they do 50, it's always big calamities around the corner for the economy, other than last September. I would caveat that. I think the Fed would prefer to go slow and do 25 at a time. I think part of that is the Fed's always reacting to the last crisis. And so the last crisis was they spurred inflation because they were too late to the party. So now they are worried about spurring inflation again. Well, maybe the employment side is the crisis that's building, but they're going to focus on the past one.
But what about, Jeff, what are the risks, I guess, to consider if you start cutting when you're still above target on inflation?
Yeah, I mean, the risk is you reignite it. But I think what we're seeing with the employment data is that it's hard. And you're seeing this economy where we're not losing jobs yet, but we're not creating jobs. So if you start to get job losses, that could spiral the country into a recession fairly quickly. And I think will ultimately be the bigger concern. But you know, we have to have inflation in the back of the mind. I do think that's why we're going to ultimately have a steeper yield curve, because if you buy a 5-year security, you don't worry as much about inflation as you do on a 30-year security. And so I think as the Fed cuts, the yield curve is going to steepen a bit because everybody's going to be a little bit concerned because inflation data isn't coming down yet. But a recession is always a really good cure for.
Well, let me ask you, I know you're not an economist, Jeff, but you have views on this.
Yes.
What is your sense of where the broader U.S. economy is and where we're headed? Are we just slowing? Do you worry about something worse?
I do think we're just slowing at this point in time. I'm not overly concerned about entering a recession immediately. That being said, if you're not creating jobs, that creates a lot of risk to the economy. The housing market, as we know, has slowed quite a bit. You start seeing certain areas of the country having negative home price growth this year. So there are some warning flags right now. But with the equity market up fairly strong, companies have not started really laying people off. I'm not that concerned about a recession, but the Fed has to worry about that because if they make a mistake, then they're going to have a lot of catching up to do on rates.
Your benchmark 10-year, Jeff, we're at 405 here. Where do you think we are? Where are we headed near to intermediate term?
Yeah, I think we're probably entering into like a 375 to 4.25 type of range. I think that unless you get Fed funds well below 3%, it's hard to justify a 10-year Treasury much below 375. So if that's a bad signal, if the 10-year Treasury keeps coming down a lot more than that, that's telling us the Fed's well behind the curve. So I hope we don't see a lot lower 10-year Treasury other than those of us who would like to refinance.
Let me ask you a final question, Jeff. Given this backdrop, given this environment, fixed income investors, they ask you where are the best opportunities. What do you see?
I think it's moving up in quality. So if you're looking, high quality investment grade credit still looks attractive. Balance sheets are really good. You're looking at areas like agency mortgages. We haven't been able to see this much yield in high quality instruments since pre-financial crisis. So even though rates have come down a bit, 4% on a 10-year note, if you can get a high quality corporate bond in the high 4%, that's pretty good, especially if inflation's trending down and you're starting to earn 2 to 3% real returns.
I know you're U.S. focused, Jeff, but quickly, are there opportunities overseas, internationally?
Yeah, we do think that, especially in non-dollar, it looks attractive. The U.S. dollar may bounce back a little bit here in the short run. Historically, when everybody else is cutting and if the Federal Reserve is keeping rates steady, that's usually a pretty good U.S. dollar positive environment, right? You stretch out. Now, all of a sudden, maybe Europe is not cutting rates anymore and the U.S. is dropping rates. That could cause the U.S. dollar to weaken a bit more versus the European currencies.
Jeff, great to see you. Appreciate your time.
Thank you, Josh.
Thank you, sir. We are just getting started here on Market Domination. Coming right up, SiriusXM gets a shock from its number one shock jock. It's good news for shareholders. Plus, winter is coming and some analysts are feeling bullish on Canada Goose. We'll explain why. And pet supplies provider Chewy is making moves. Stay with us to see if it's top dog. All those stories and a whole lot more when we return. Stick with us. The real estate market has been on a turbulent ride amid a higher for longer rate environment. However, our next guest is pointing out pockets of opportunity. Let's get to David Steinbach, Global Chief Investment Officer and a Managing Partner at Hines. David, always great to see you. I want to dig, David, into the commercial real estate market with you. And kind of just start big picture, David. You look at that CRE market. If I asked you to compare it, David, to maybe 6 months ago or 12 months ago, how would you characterize it, David? Same, better, worse? What are you seeing?
I think things are starting to level in, and I think a lot of the expectations on rates and where they're going to end this year are starting to get priced in. The summer, I'd even say the spring was relatively slow on transactions versus prior years, but we're seeing a pretty big pickup post Labor Day here in the United States, at least. And certainly as Europe comes back from summer, we're seeing more activity than we saw a year ago.
So if it's improving, at least here in the U.S., David, walk me through just the variables, the reasons for that.
I think some of it is sentiment and a belief of where interest rates are going to be. I also think that the market is starting to wake up to the fact that there really hasn't been a lot of new supply coming online. And, the real drawdown on new supply is pretty significant right now, really in most every major product type within commercial real estate. So that, I think, is creating a real acquisition opportunity as market participants see the fact there isn't a lot of new things coming down the pike. And that in time will bring rent growth, which means making a purchase today is going to be looked back as a smart move. And that rent growth eventually will lead into more development occurring, but that's probably a little ways off still.
One trend I'm always so interested in, David, is that trend of reformatting, repurposing office buildings for residential. How real is that trend? What kind of traction do you see there?
Well, the U.S. overall is about 2.5 million houses short, according to our own math. And that's a pretty significant shortage. I mean, back in, right ahead of the GFC 2007, it was quite the opposite, right? We had an oversupply of housing. So there's a real shortage. And at the same time, there's been some headwinds in office, although that's starting to find its own level as well. And there's been several groups, including ourselves, have looked at doing these resi conversions, particularly of office. It's been tough. Just in one word, it's been really tough. I think there have been some that have been successful, but there's a lot of technical specifications. There's a lot of things you have to do. So I don't see that as being a real unlock of satiating the undersupply and the demand. I think we're just going to have to build things. But again, just the math right now for development is really tough as well.
Let me ask you, David, the market thinks a cut by the Fed is a lock here at that next meeting. Let's say we do get the cut. What does that mean for the CRE market?
Well, I think, think about it in a couple of different dimensions. I think, first of all, I do think it is pretty much expected now that cut will occur. That has not happened yet, though. So if you are, a potential home buyer looking at a mortgage, that's not fully baked in. So that might cause some home buyers to wait to rent. In addition, the economy is feeling a little less on footing than it was maybe 9-12 months ago. That's also pushing people into renting. So there is a real dynamic into for rent housing. And we see an opportunity with that. And then more broadly, I think that the cut in light of the run up that we had, the 500 basis points that really began in 2022, a 25 basis point, which is probably what it likely will be, is relatively insignificant to the run up we've had. So it's going to help the system. I think it's getting priced in very quickly, but I don't see it being a massive unlock either.
Final question, David. You do have important international line of sight as well. I'm curious what kinds of opportunities potentially you're seeing overseas, Europe, Asia.
There are a lot. The world is a big place, and in this era of deglobalization, if you will, there's new opportunities, new trade routes, frankly, picking up. There's a lot of interesting things happening in Mexico that we weren't seeing before. In places like Europe, they have there has been a bit of a decoupling in terms of the way the economies have been historically interlocked, and we think that there's going to be some very interesting opportunities on the continent, particularly as European governments start doing spending, particularly around military. Even in the UK, things have repriced more quickly in the UK than a lot of other markets that we track. Markets like Japan, Australia, we're very long living there as well. There is housing shortages, but also just a product doesn't exist that needs to be built. And so we're very active and interested there, in addition to logistics globally.
David, always great to see you and to have you on the show. Thank you.
Thanks so much.
Now time for some of today's trending tickers. Yahoo Finance's Ali Canal joins me now for a look at SiriusXM, Canada Goose, and Chewy. Let's start here at Howard Stern revealing he is not leaving his longtime SiriusXM radio show, clarifying the hoax with Bravo host Andy Cohen. I guess what happened here, Ali, was a sort of kind of gag, I guess, that where Stern wasn't at the mic initially and TV host Andy Cohen was, so maybe Stern was gone. And we did have these kind of media reports that has suggested maybe he was leaving and the stock responded, but then no, it was a gag. Stern was on air.
Yeah, the stock fell around 2% after this rumor started circulating that he was leaving Sirius. And the timing is interesting too, because his contract future remains uncertain. So maybe in those negotiations, he can point to the stock move when it comes to how important he is for this company. But he last signed a 5-year deal in 2020. He said talks have been going, quote, fantastic. He's, quote, very happy there, although he hasn't made a decision. And we've seen across the board, whether it be these pure play radio media companies like Sirius or some of those other tech giants like Amazon, really throwing a lot of money at these podcasters, at these creators. Alex Cooper, she's at Sirius. She signed a $50 million deal. We have Amazon signing New Heights. That's the Travis Kelce and Jason Kelce podcast. And I'm sure that's been seeing a boon since the Taylor Swift, Travis Kelce engagement. And really across the board here, whether you look at a Joe Rogan or a Howard Stern, there's a lot of money to be had from Spotify, Amazon, Sirius. So you would think that he's shopping around and seeing what he can find out.
Yeah, it doesn't sound like SiriusXM has officially confirmed his contract, but the contract report, so it does expire at the end of 2025, estimated to be $100 million a year. Way to go, Howard.
Yeah,
there you go.
way to go.
Turning to Canada Goose, those shares surging as TD Cowen upgrades that name to a buy. So this one, okay, analyst sees Alley improving sales and margins. They talk about the next 2 quarters will likely benefit from marketing investments, newer product launches. They also say our estimates, which call for 9% sales growth in Q2 26 and Q3 26, could prove to be conservative.
Right, and really it's that year-round lifestyle offerings that the analyst is pointing to here with Canada Goose. The analyst there, Oliver Chen, expects marketing investments in fresh products to drive growth, with 9% sales projected in the second and third quarters of 2026. Now, there were reports of a take-private bid that started circulating in August. Canada Goose executives said earlier this month that no deal has been in the works at this point. Chen said that a leveraged buyout could still provide a floor for the brand and modestly expand margins. But you're looking at a chart there, and really year to date, we have seen this stock surge up.
It's up about 50%.
50%. It's trading near the high end of its 52-week range. It seems like the price target, there seems to be more room to run here, maybe even 20% more as we look ahead to the end of the year. So it feels like there's a lot of bullishness around this name at this point.
For sure. All right, finally, Chewy get an upgrade. Look at that one. From Mizuho, the firm lifting its rating on that stock from neutral to outperform. So they're now believers. Next earnings announcement is September 10th. Analysts expect strong Q2 results, modest boost to both revenue and adjusted EBITDA forecast. Think second half results will alleviate several investor concerns. Target set at 50 on this one.
Yeah, that implies around 20% upside based on these current levels. We're seeing shares off slightly today, but year to date, we are up about 25%. So not too bad of a rally, outpacing the benchmark S&P 500. In the second half of the year, the analysts said that investors should really have their worries eased when it comes to customer growth, expecting 100,000 net adds per quarter. Core margin pressure is fading as auto ship discounts roll off, expense leverage returning after that heavy first quarter investment spend, and that's something that was really weighing on the minds of investors. And across the street here, 19 buys, 12 holds, and no sells, and the average price target is $46 a share. We are trading below that. So again, another name with potentially more upside.
Thank you, Allie. Coming up, Snowflake in San Francisco, we're speaking with the software maker's CEO about the effects of AI on its products and competition. It's a conversation out of Goldman Sachs' Signature Tech Gathering, and you won't want to miss it. Stick with us. Yahoo Finance executive editor Brian Sozzi is out in San Francisco as tech leaders descend on a key conference. He's talking all things AI with Snowflake's CEO.
Yahoo Finance has descended once more to the Goldman Sachs Communacopia Conference in San Francisco, focused on all things tech, a little bit of media, and of course a lot of AI. I want to lean into that AI story right now with Snowflake CEO Sridhar Ramaswamy. Sridhar, good to see you in person for a change.
Amazing. Yeah. Eye contact. Great to see you, Brian.
Yes, it's a good thing indeed. You just came off your earnings report.
Yep.
Really good quarter for you guys, but I came away thinking AI is entering another stage, not just for Snowflake, but for the industry.
Yeah.
Is that a correct assessment?
That's a very good assessment. I think AI slowly but surely is going from hype to reality. And I'm very proud of the role that we have played there. We are right at the center of enterprise AI. We said, let's make AI simple and easy to use. And we have 6,000 customers using our AI products. And things like chatbots, half hour of work. It's that easy to set up. But then now you're beginning to see heavyweight applications roll out with people like BlackRock or Thomson Reuters, or even inside Snowflake. And I'll have an app on my phone that has access to all of our sales information, any question under the sun. I think that's the kind of transformational stuff that's happening.
Your business appears to have accelerated in the most recent quarter. What do you attribute that to?
We've been consistent about this, Brian, which is at the core of Snowflake is always the analytics workloads. These are the workhorses that drive Snowflake. We have excellent net revenue retention, 125% plus quarter, and investing a lot into things like AI-driven migrations, because migration is a messy activity. like these legacy systems, legacy pipelines, everything has to be perfect. But AI can automate a lot of that kind of just drudgery. And so we are seeing solid core with analytics. It's the newer products, whether it is data engineering or AI, that are adding the little oomph on top, and that's the thing that we want to continue to press very hard on. And the cool thing now is a lot of CIOs and CEOs, in fact, are realizing that great data that's on Snowflake, AI-ready data, now has the potential for business transformation. And so instead of analytics leading, all of a sudden it's going to, hey, we want to be AI-ready, and therefore we should move the data to a modern platform, and that's like the wind on our sails that you're seeing as well.
I just talked to Jan Hatzius, Goldman Sachs chief economist. He said he characterized the economy as stall speed. Have you seen that expressed in AI orders for your business?
We are always measured when it comes to AI. One of the beautiful things about a consumption business is we are driven by value. We make money only our customers actually use the product and get value out of it. And we make it super easy to experiment with AI, so people don't have to sign up for a $5 million contract before they get anything done. They can always start small. We are not really seeing any stalls in things like, are people signing more deals with Snowflake? That continues to be a key part of how we operate our business. Honestly, that's what drives things like our cash flow. So things are going well on that side.
Last time I talked to you, it was around the time of DeepSeek. It came out.
Yeah.
It shocked the market. And you had some good thoughts on that. Where do you see Chinese companies playing in AI? Is there another DeepSeek moment for this industry?
I think it's just a time of incredible change, where predictions honestly are just really, really hard. And if you see even the leading frontier models, it's like neck and neck. It's like, hey, Grok's going to catch up. No, GPT-5 is the best, but here's a different coding model. I think that's a good thing. I do see this trend of broader democratization play out, but the benefit that you get right now, even if it's over the space of months, from truly being at the cutting edge, from being out there, is also tremendous. It's just a lot of stuff roiling the world of AI.
Yeah. Is the next big AI development likely to come out of overseas company, like in China?
Innovation can come from anywhere. I actually think that that's a good lesson for all of us, that we cannot be complacent. That's the message that I give to Snowflake. It's just like, hey, we are doing well, but understand there's a ton of competition that is coming at us because enterprise AI is such a big deal. I think this is back to the original, only the paranoid survive. You have to be that to survive right now.
There is a narrative already starting to appear at this conference on software companies almost at an existential crisis because of AI. I mean, I think it's overblown, but still, how do you see the future of software companies because of AI? How big a threat is it?
Software and services as we know them are going to be profoundly affected by AI. There's just no question about it. Why? Because I'm a modest programmer, not great, but if I have to go do something even slightly meaningful, it would take me weeks to do this. I can knock it out with 2 hours of vibe coding without really having to know like the super nitty-gritty details if you have a concept. And so your ability to develop an application just as quickly is also quite amazing. So I think there is definitely a shift in the gravity towards data, because actual data about what happened in the world, whether it's a call transcript or how did your business do, that's the goal. And that's what's driving our momentum, because other things that you can do on top, there's just an explosion of innovation that is happening. I think what you're seeing investors do though is sort of take some of these insights and essentially roll them out to infinity, which, as you know, might not be how
some of these
things
software
work.
stocks are now trading at record low valuations in some cases.
I think there's definitely a case to be made that some investors are taking these early nuggets and just rolling them out like way forward. Remember, this is a dynamic world. The software companies are not going to be sitting still. They are going to figure out how they can disrupt themselves, how they can create new services. But what I feel very confident about is this is very much a before and an after moment, just like the internet. But exactly how it's going to roll out, I think it's just really hard to call.
Can they figure it out? I mean, I look at some of the biggest software companies in the world. What do they do? What do they even look like 5 years from now?
Yeah, I think they, first of all, as I said, the data foundation is important. If you have 1 million customers, having that data in a way that is amenable to people consuming it, to AI consuming it, that's a big deal. That's not a matter of debate. You can have 4 different interfaces to that data, but you better have the data in one place. I think you're going to see a lot of just flexible UI paradigms on top. UI has always been really hard to create. Like building web pages, slow, painful. Same for apps. I think you're entering a world in which you're just limited by your imagination when it comes to things like that. So you're going to see a lot of, a lot of innovation. I think more and more software companies become like Snowflake, where there is a core data layer, and then there's a bunch of stuff that they add on top, but they also expose agent functionality for here are things that you can do with our data, and then the world gets basically rewired together, if I can use that word. I think, but they're going to try just as hard because there is nothing like an existential threat to drive innovation in your own business model.
No, that's a real good point. Snowflake CEO Sridhar Ramaswamy, good to see you in person for a change.
Great to see you,
Let's
Brian.
do this more
Thank
often.
you.
New wave of crypto-related IPOs are hitting the market. Our next guest initiating coverage on one of those names, Bullish, saying the company has opportunity to take market share in the U.S. where institutional trading is dominated by Coinbase. We're navigating how to play the burgeoning sector with the Yahoo Finance playbook. And joining me now, we've got Ed Engel, senior analyst at Compass Point Research and Trading. Ed, it's great to see you. So, big picture, Ed, you see this number of crypto firms taking a public market plunge, and especially, Ed, this activity around crypto exchanges. And I'm wondering what explains that trend, Ed. Is that, hey, listen, if you're in crypto, you got a friend in the White House? Is it the regulatory changes? What explains this theme?
Yeah, absolutely. So, as of today, one of the core drivers of crypto activity is trading. And a lot of that is from Bitcoin trading and increasingly more altcoin trading. So I'd say the fastest way that traditional non-decentralized companies have monetized this is via crypto exchanges. And we're seeing that where some of the biggest crypto companies in the world do end up being crypto exchanges, whether they're Coinbase, Binance, or emerging entrants such as Bullish.
All right, let's talk about Bullish, Ed, because I believe you got a neutral on that one, Ed. So you're on the sidelines. Is that, in broad strokes, is that because, you just see risk reward balanced here at current valuation?
Yeah, absolutely. So we think it's a phenomenal company. It's got a phenomenal opportunity, not just globally, but also the U.S. I think the one thing that keeps us on the sideline is we're a little bit unsure of how they do get into the U.S. market. So currently they're operating in regulated jurisdictions outside the U.S. As you know, the U.S. regulatory environment has been not the most hospitable over the past couple of years, but Bullish is seeking to have a license. I think the problem, though, is in the meantime, until we get some broad-based crypto regulation, such as the Clarity Act, there's no direct path for a crypto company to get regulated in the U.S. today. And so we're a little bit cautious on them getting into the U.S. without kind of a formal regulatory framework. And we don't expect that to happen really until sometime next year. So I think the very near term, we have a hard time seeing them get into the U.S. in 2025, and then potentially there's an opportunity next year. But we'd like to see a little bit more clarity on the U.S. regulatory side before getting a bit more confident in Bullish here. Can
I also ask you, Ed, just when you look at the competitive landscape, what makes them different? What is their advantage versus, a Binance or a Coinbase?
Mm-hmm. Yeah, so these guys compete in international markets, and international markets are much more competitive than in the U.S. The barriers to entry outside the U.S. are much lower, especially for some of these unregulated exchanges that have kind of dominated the industry in recent years. And so Bullish competes with these ginormous international exchanges like Binance, OKX, Bybit. And to do that, they've really had to compete on pricing. And so if they're able to compete on pricing in these extremely competitive international markets, we think that if they were to get in the U.S. where things are a little bit less competitive, they could take some market share from Coinbase just by offering a better pricing and pretty favorable liquidity, especially versus some of the other U.S. competitors.
Does it matter to you, Ed, as a financial analyst, to you or your clients, when you got a heavy hitter like a Peter Thiel behind a name like Bullish?
Yeah, absolutely. And then Bullish's CEO, Tom Farley, he's been on Wall Street for a while. He was had a number of executive roles at NYSE Group and NICE. And I would say that that definitely makes a difference for investors, especially in crypto, where a lot of the actors have a little bit more murky past. It's a little bit harder to kind of background check a lot of these other major players in the crypto industry. And just to have someone more kind of buttoned up and a bit more mainstream, I think does make investors a little bit more comfortable investing in some of these crypto companies.
It's interesting. Ed, all right, so you're neutral on Bullish. Let's get to a name you like. Robinhood in the news, surging today. It's going to be added to the S&P 500. It's up about 15% right now. You're a fan of this name, Ed?
Yeah, absolutely. So, I mean, they've been snubbed on the S&P inclusion for, we think, 1 to 2 quarters. So I think this was more of a matter of time rather than, so we shouldn't be too surprised by it. But in terms of just the U.S. regulatory environment improving, we don't see many companies that benefit more. So this company, they've got millions of users across the platform, not just trading crypto, but trading kind of everything, whether it's prediction markets, options, equities. And our view is that as the U.S. regulatory environment improves, these guys can monetize this existing user base better by offering more products and services that are now allowed in the U.S.
All right, so you got a buy on Robinhood. You got a neutral on Bullish. Let's go with a sell next here. You have a sell on Circle, Ed, which is interesting. I mean, listen, a lot of interest in stable coins, a lot of interest and excitement over maybe the adoption curve there, Ed. Is this call in part, you're not a believer in that adoption curve?
No, we're extremely bullish in stablecoin adoption. We're extremely bullish on blockchains disrupting the financial industry. I think for Circle is one of our issues is as these become mainstream, we have a hard time seeing 1 or 2 companies dominate an entire industry. And so especially I'd say this is a bit more middleware where yes, liquidity does matter, but in terms of the technology behind it, there's tons of different platforms out there that offer, I'd say, similar, maybe not as good technology, but still decent technology. And our view is that as more of these mainstream banks and fintech companies want to get involved, they can partner with maybe one of Circle's competitors and offer maybe almost as good service. And so it's more of a market share idea where we think that this industry is going to be a little bit more fragmented than it is today, where it's really just dominated by 2 players.
I want to squeeze one last one in here, Ed, if I can. Another name you cover, Michael Saylor's Strategy. That's also surfaced as a potential S&P 500 entrant. I'm just curious, what do you make of that, Ed, and why is this one still a buy in your opinion?
Absolutely, yes. So, I mean, we're long-term bulls on Bitcoin, especially here at Compass Point. We've been covering crypto for 5+ years. And for MicroStrategy, it's really still the best proxy to get exposure to Bitcoin. In terms of their S&P inclusion, they actually didn't quite qualify for S&P inclusion until last quarter when they actually reported their first full quarter of significant profits. A lot of that was change in accounting standards that actually just took effect for a lot of companies this year. And so our view is that, hey, if you want Bitcoin exposure, not only has this company, obviously, they track Bitcoin, just given that's a vast majority of the valuation, but they've found an ability to increase their Bitcoin per share in both bull, extreme kind of euphoric environments, and even in today, where they're not necessarily selling stock like most of the other crypto treasury companies, they're finding more creative ways to kind of finance this acquisition of more Bitcoin, which helps them kind of outperform, we think, Bitcoin, just given that they can increase their Bitcoin per share over time.
All right, thank you, Ed. Appreciate your time and those picks.
Thank you.
Coming up, the modern markets have a rich history that's tied to the birth of our nation, and there are many living legends to share the stories of Wall Street. Stay with us. We're learning about the beginning of the bull market. Stick with us. In the late 1970s and early 1980s, America was on the ropes, facing high prices and high joblessness all at once. Then Paul Volcker, appointed in 1979 as Fed chair, took a sledgehammer to inflation, jacking rates toward 20%. By 1981, Ronald Reagan inherited an economy in crisis, but then came an unexpected moment. On August 17, 1982, Volcker and the Fed announced a 10% rate cut. That day marked the bottom for the markets and the birth of the most powerful bull market in U.S. history. Yahoo Finance Trader Talk host Kenny Polcari sat down with Jimmy Rutledge of the NYSE Board of Directors to connect the threads on what was felt and what it meant for markets.
When I came out as a broker the average daily volume was 12 million shares a day.
12 million.
12 million.
Today we're trading 19 billion.
That's correct. And going into 1980, it had increased, but only to 45 million.
Right.
Which, compared to 12 million, is a lot.
It's a lot.
But it was an odd lot, so to speak,
Right.
as we continue to progress. And we started going into Volcker, et cetera, et cetera. It started rising, and it rose very quickly.
Right. But wait, before we get to Volcker, let's just talk about the end of the Carter years, what was happening in terms of, to your point, a taxi medallion in New York City cost more than a seat at the New York Stock Exchange because
you couldn't make a living down here.
Couldn't make a living.
There was no activity.
Right.
And when there was activity, it was inconsequential.
Right.
In addition to that, during that period, we went from fixed floor brokerage
Right.
and fixed rates,
Right.
which impacted. It was good, ultimately good because it increased volume.
Right.
And we started to come out of this
We went
malaise.
to negotiated rates, which is what went from fixed to negotiated.
That's
and
correct,
that's what lit the fuel.
Yeah. So going into 80, we were still doing nothing. We weren't making a living, but things were getting better.
Right.
And then the market exploded in
Right.
82, and it was happy days are here again.
Right.
And it continued right up until.
Right. So I was in college in 1980, 81, 82, and I had the opportunity to come and work here as an intern on the floor. You know, you ran, right? You were a gopher. But that's okay. I'd never had any exposure here, and so I came here. I learned about the business. I was here in 80 when it was really dead.
Yeah.
81, I was making $500 a week with Doug McQuaid. I was making $500 a week in 1981. In 1982, when I came back, it was at the depths of the economic malaise. It was horrible. And Doug McQuaid, who was an independent broker, said to me, "I can't afford the $500 a week to have you." I thought to myself, wow, okay, maybe this is the summer I'm going to be a lifeguard on the beach. And that's when I ran into Billy Latham.
You would have drowned.
Yeah,
So
yeah.
That's good miss.
I ran into Latham, who was actually doing a bunch of option-related layoff business. That was kind of the core of his business. He put his arm around me and he said to me, "Hey, kid, you know the symbol for IBM?" I go, "Yes, sir, it's IBM."
You're hired.
He goes, "You know the difference from an eighth and a quarter?" I said, "Yeah, it's 12 and a half cents." He said, "Great. When can you start?" I go, "Now." He said to me, "How's $1,000 a week?" I was like, "What?"
Jeez.
It was great. He was unbelievable. But anyway, in 1982, the summer as we moved into the summer, there was nothing happening here, right? Rates again were 20%.
That's right. Yeah, you could throw a bowling ball down this place and not hit anybody.
Yeah.
But I will tell you, I started to transition my business as an independent, and I was doing business for a specialist in Chicago,
Right.
who was doing layoff business here and doing options and futures.
Right.
So that was a whole new exposure
Right.
for me.
Right.
And it bailed me out.
And it bailed out a lot of guys, by
Yes.
the way, right? It bailed out a lot of guys. But so let's talk about as we led up to August 17th. It was in the middle of summer. It was this August doldrums, all that stuff. And there was a word because there was no TV, there was no internet, there was no radio. The only way we got information downstairs was we read the newspaper or somebody from upstairs called
us. That's right.
to tell us what was happening.
Yeah.
And so on Tuesday morning, the Fed came out with that surprise announcement because it was a surprise on that day.
Certainly a surprise to me.
And at 8:30, it was about 8:30 and 30 seconds, every phone rang. Do you remember it? It was like Christmas.
Yep. And I can remember I had two clerks at that time, and both of them they got buried.
Right.
And I was doing what was called $2 business
Right.
for Solomon Brothers,
Right.
which was right around the corner from my booth. And they were buried because they were not only getting the traditional orders, but they were getting program orders, which none of us knew about.
Knew what they were. It was a
And-
new phenomenon.
Exactly. And it was total pandemonium until the close and then some.
Right. But so explain the kind of orders you were getting. When the phone rang, the upstairs trader was giving you what kind of orders?
Basically, buy 1 million shares and don't come back until I own them.
Until you own them.
And then when you come back and say, okay, you bought 100,000 at a quarter or 100,000 at 3/8. I was a particularly good broker, so I bought some at an eighth.
At
right
every
behind that.
fraction. At every fraction.
There you go. And the guy would take the reports, not even question the reports,
Right.
Take another $1 million to buy.
But everybody, every broker, because I was in the booth as a clerk. Every time the phone rang, I'd pick it up and somebody would scream another buy order at me.
Yeah.
Every broker, no one was getting sell orders. Everyone was getting buy orders.
That's right.
And so the market ran, I'll never forget it, 35 points on the Dow. That was 4.5%, which was a big move.
That's right. Yeah.
Right?
Yeah.
And everybody was stunned. We were all like, what?
It was a move that I had never seen before.
Right.
And as I recall, when we came in the next day, we expected the same kind of activity.
Right.
It was busy as hell, but nowhere near what it was. And we were so surprised.
Right.
Now we were anticipatory, if you will.
Right, but while it started to slow, it remained elevated for a while.
Oh, yeah.
And the market remained very robust going into the fall that year.
Yeah. And the fall was pretty busy as well.
Right.
But a hell of a lot more calm.
But calmer, but still busy.
Oh, yeah.
Right? It still had that excitement to it, right? I mean, it was exciting every day, no matter which day. It was just exciting, whatever the news was, to create the action on the floor, because the action was really
It was the best job on the planet.
the best job
Couldn't
on
wait
the
to come to work.
Yeah.
Not a lot of people got to say that, but it was the best. I'm here 57 years, and I still like coming to this place.
So do I. So even though it's changed, so do I. Jimmy, listen, it was a pleasure talking to you. Thank you very much for helping me kind of reminisce about the birth of the greatest bull market that this country has ever seen.
Anytime, kid.
Always a pleasure.
Market starting the week on an upbeat note. The NASDAQ hitting a record high, even as investors wait on key economic data. We're wrapping up today's market domination, but don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.